Hey everyone, and welcome back to Talk Tickers. You know, we love to dig into those earnings calls, and today we're strapping in for a deep dive into Evolent Health's Q4 2024 report.
It's been a wild ride in the healthcare world, hasn't it?
It really has.
And Evolent's year, well, it's been a bit of a roller coaster too. We're going to break down what's really going on behind those numbers. And trust me, this isn't your typical, oh, look, a company made some money kind of story.
Yeah, definitely not your straightforward earnings report.
Exactly. It's more like, hold on tight, we're about to navigate some serious healthcare rapids. Evolent exceeded revenue expectations.
It's always good news for investors.
Right. They hit $2.55 billion in 2024.
Okay, so a 30% jump from the year before.
Exactly. A 30% jump. Now, their adjusted EBITDA landed at $160.5 million.
Which, on the surface, doesn't sound bad at all.
Not bad at all. But that's where things get interesting, because that $160.5 million, that was at the lower end of their projection. So the question is, what happened?
Yeah. What's the story there? Evolent's bringing in a ton of revenue, that's clear. But what's eating into their profits?
Well, one word: oncology. It's been a major factor impacting their bottom line. Those costs associated with cancer care, through the roof.
Yeah, I'm not surprised. Cancer treatments are notoriously expensive. But how did that affect Evolent specifically?
Their Performance Suite segment. That's
Yeah.
where they're taking on more financial risk for patient outcomes.
Right, so they're not just providing services, they're actually sharing in the cost of care.
Exactly. It's a bold move.
Mm.
And it makes them more vulnerable when costs spike unexpectedly, like they did with oncology. Imagine trying to predict the weather in a hurricane. That's kind of what it's been like for Evolent, trying to predict and manage oncology costs.
So it sounds like they were hit pretty hard.
Hard is an understatement. But they didn't just sit back and watch their margins evaporate. They took action, renegotiating contracts, implementing strategic changes. It was all hands on deck to regain control of those costs.
Okay, so they tackle those immediate challenges. But what about their overall strategy? I mean, are they going to shy away from those riskier contracts now?
That's where it gets interesting. For 2025, they're still projecting a really solid growth rate, between 15 and 18%.
Wow, that's impressive given the challenges they faced this past year.
Right. And it's not just wishful thinking either. They've already secured some new contracts, and they've got a seriously strong pipeline. They just signed a deal with a major health plan in New England, 2 million new members. This signals that they're still confident in their ability to manage risk effectively moving forward.
Wow, 2 million new members. That's a huge win for them. This growth strategy is really intriguing. What else is fueling their optimism for the coming year?
All right, so they laid out a 3-point plan for success. First, growth. We just talked about that. New clients, expanding with existing ones.
Okay, so they're hitting the gas on growth. What's point number 2?
Margins. They're laser focused on improving them. They're talking about automation, AI-powered efficiencies, basically becoming a lean, mean healthcare machine. They're aiming to offset those projected oncology cost increases, which, by the way, they're still budgeting at a conservative 12%.
So even though they're expecting those cancer care costs to keep rising, they believe they can handle it through efficiency and technology. That's a bold bet.
It is. And that leads us to their third point: capital allocation.
All right, so how are they planning to invest their resources?
Well, they're all about investing in product development. Got to stay ahead of the curve.
Makes sense. Healthcare is constantly evolving.
Exactly. But they're also keeping a close eye on their debt, making sure it stays under control. And there's even been some talk of potential mergers and acquisitions down the line, which is always exciting.
Mergers and acquisitions, that could definitely shake things up. So to recap, they're growing, streamlining operations, and potentially expanding through acquisitions. All this while navigating a healthcare system that's in constant flux.
It's a lot to juggle, but here's what really struck me about this earnings call. It wasn't just about the numbers.
Okay, I'm intrigued. What else stood out to you?
They consistently emphasize their dedication to patient-centered care, which, let's be honest, is refreshingly different in an industry that often seems obsessed with financial metrics.
Yeah, it's easy to get caught up in the spreadsheets and forget that behind all those numbers are real people trying to navigate the healthcare system.
Exactly. And Evolent seems to really get that. They're not just crunching numbers, they're connecting doctors with the latest clinical evidence. They want to ensure that patients are getting the most appropriate and effective treatments possible. In fact, get this. They facilitated over 240,000 peer-to-peer conversations between physicians last year.
240,000 conversations. That's incredible.
It is. It's like having a network of expert consultants available to doctors across the country, helping them make better decisions for their patients.
That's a powerful image. It really shows how Evolent is trying to improve healthcare for both the providers and the patients.
Exactly. It's not just about profits. It's about making a tangible difference in people's lives.
And that's something we can all appreciate.
Absolutely. So when you look at the bigger picture, it's clear that Evolent is trying to strike a delicate balance. They want to drive innovation, they want to make healthcare more affordable, and they want to prioritize patient well-being. It's a tall order in a system that can often feel like it's working against itself.
It is, but it's a system we all have to navigate, whether we're investors, healthcare professionals, or just trying to understand our own medical bills.
Yeah.
And that's what makes Evolent's story so relevant.
Absolutely. So what does all of this mean for you, whether you're deep into healthcare stocks or just trying to make sense of your own medical expenses? Evolent's story is a reminder. There are companies out there working to make a positive impact in a system that can often feel, well, overwhelming.
It's kind of a beacon of hope, right? Like maybe, just maybe, someone's got a handle on this whole healthcare thing.
Maybe.
But before we get too deep into those specific financial details, let's take a quick detour, a little trip into the world of this is not financial advice.
Oh, I love these detours. What you got for us today?
Well, Evolent is really going all in on this AI and automation thing to streamline those processes and boost those margins, right?
Right.
So imagine if they take it even further. What if their AI platform becomes so sophisticated, so good at predicting and managing those healthcare costs that they decide to spin it off into a whole separate business?
Hold on. You're talking about turning their AI into its own standalone product, something they could sell to other healthcare companies. That's a pretty bold move.
It is. But think about it. They've got mountains of data and an AI engine that's constantly learning.
True.
Why keep all that power to themselves? They could license this technology, create a whole new revenue stream, potentially even dominate the healthcare AI market.
I like where you're going with this. So we're not just betting on Evolent, the company.
Right.
We're betting on their AI to revolutionize the entire healthcare industry.
Exactly. It's definitely high risk, high reward. But if they pull it off...
Investors who get in early could see some serious returns.
Absolutely. Now, obviously, this is all purely hypothetical. This is not financial advice.
Of course.
But it's fun to speculate, right?
Mm-hmm.
And who knows, maybe this crazy idea will inspire some real innovation in the healthcare world.
That's what we love to do here at Talk Tickers, spark those innovative ideas. All right, let's get back to the nitty-gritty of this earnings call and break down those numbers.
Yes, let's do it. They reported $2.55 billion in revenue for 2024. But it sounds like there are some adjustments we need to take into account.
You're right. They're changing how they recognize revenue, specifically for 3 of their Performance Suite contracts. One's being converted to technology and services. The other 2, they're shifting from gross to net revenue recognition.
Okay, help me out here. What's the difference between gross and net revenue?
Think of it like this. Gross revenue. That's the total amount billed. Net revenue. That's what's left over after you count for all the deductions. Things like discounts and allowances. This move gives a clearer picture of their core earnings.
Got it. So some accounting adjustments. Is this a red flag? Should investors be worried?
Not necessarily. The important thing is these changes don't impact their projected profitability or their long-term margin goals. It's more about streamlining their reporting, focusing on those core offerings, which mainly revolve around specialized care like oncology and cardiology.
Okay, so taking these adjustments into account, what's the real revenue baseline we should be looking at?
They call it their adjusted revenue, and it comes in at about $1.79 billion. And from there, they're projecting that organic growth of 15 to 18%. That brings their 2025 revenue guidance to somewhere between $2.06 billion and $2.11 billion.
All right, so they're still anticipating some pretty healthy growth, even after we factor in the adjustments. But what about profitability? You mentioned that adjusted EBITDA of $160.5 million they reported for 2024. What's their guide looking like for 2025?
Well, their guidance for 2025 puts adjusted EBITDA between $135 million and $165 million.
Okay, so at first glance, that might seem like a step backward, but I have a feeling there's more to the story, right?
Always. Remember those pesky oncology costs we talked about earlier?
How could I forget? They seem to be the elephant in the room.
Exactly. And on top of that, they're dealing with the impact of partners exiting certain health plans.
Oh, right. You mentioned that earlier. primarily in the Medicare Advantage space.
Yep. That's going to cost them about $20 million in EBITDA.
So between those higher oncology costs and those partner exits, they're essentially starting 2025 in a bit of a hole.
You could say that, but don't forget about those contract renegotiations and their efficiency initiatives. Those are working in their favor. Plus, there's that $25 million in expected EBITDA expansion from organic growth.
Okay, so there are a lot of moving parts here. It's like a financial balancing act.
And that's why we're here to break it all down. So let's zoom in on those oncology cost projections. Remember, they came in higher than expected at 11% in Q4 of 2024.
Right, and now they're forecasting a 12% increase for 2025. That's a pretty significant jump.
It is, but they're being conservative. They're using that 11% from Q4 as their baseline. They're not assuming any miraculous improvements.
Okay, so they're being realistic.
Exactly. And they're being realistic about the fact that those costs are probably going to keep going up.
Yeah, that's the unfortunate reality. But didn't they say something about their performance suite margins being down? Something like 800 basis points compared to their historical average? Just to put that in perspective, 1 basis point is 1/100 of 1%. So we're talking about a pretty substantial drop.
You're exactly right. And a big chunk of that decline, you guessed it, those runaway oncology costs.
Those costs are really haunting them.
They are. But here's a little good news. With the new rate increases and the contract updates, they're expecting to recover about half of that decline in 2025.
Okay, so they are taking steps to mitigate those margin pressures, but a 12% increase in oncology costs, that's still a pretty daunting number. How confident are they that they can actually manage that?
Well, their strategy seems to boil down to two key elements. One, their ability to accurately predict and manage those costs, think sophisticated data analytics, and two, their commitment to collaborating with physicians. They want to make sure patients are getting the most effective and cost-efficient treatments.
So it's a combination of cutting-edge tech and good old-fashioned human expertise working together to optimize outcomes. I like it.
It's a good approach. And it seems to be delivering some results. Remember, they mentioned that their interventions led to a 10% decrease in those checkpoint inhibitor expenses. For one large Medicaid plan, checkpoint inhibitors, those are a class of drugs used in cancer treatment. They can be incredibly expensive.
Right, so a 10% reduction in spending there is a big deal.
Huge win. It shows they're not just talking the talk, they're walking the walk when it comes to controlling those costs.
It's a good sign, for sure. It also highlights their unique position in the healthcare landscape. They're not just an insurance company or a healthcare provider. They're bridging the gap between those two worlds, using data and analytics to drive better decisions and, ultimately, improve the entire system. It's a bold vision, but it seems like they're making some progress.
It's definitely a work in progress.
Yep.
But they're on to something.
All right, so we've covered their revenue projections, their profitability outlook, and their strategy for managing those rising oncology costs. What else do we need to know about their financial picture?
Well, they touched on cash flow and how they plan to allocate capital in 2025. In the world of finance, cash flow is king.
So what's the story there?
They're expecting working capital to be a bit of a drag this year. While they finalize those client reconciliations from 2024, remember those underperforming risk contracts?
Ones they renegotiated.
Yep. They're still working out all the financial details.
Makes sense.
Yeah.
Cleaning up past financial messes can get expensive.
It can. But what about their future investments? Where are they putting their money?
Yeah, that's what I'm curious about. What are their priorities?
Well, they're allocating about $35 million to capitalize software development.
So, investing in technology, smart move, especially in healthcare, where things are changing so rapidly.
Absolutely. And beyond software development, they're prioritizing debt reduction, paying down those 2025 convertible notes that are coming due.
So they're being fiscally responsible, paying down debt, investing in growth. It sounds like they've got a solid plan in place.
They do. It's all part of their long-term value creation strategy. They're aiming for organic growth of at least 15% per year. They want to expand those adjusted EBITDA earnings by at least 20% annually. And they're focused on allocating capital efficiently, all to support those ambitious goals.
Those are some ambitious targets, but they seem pretty determined to hit them.
They do. They also mention a fourth pillar of their value creation strategy, enhancing the visibility and consistency of their earnings.
Okay, what does that mean exactly? Enhancing the visibility and consistency of their earnings.
It ties back to those performance suite contract changes we talked about. They're shifting to a model that gives their clients more upside potential, but it also caps their own downside risk.
Interesting. So they're sharing more of the wins, but also limiting their exposure to potential losses. Seems like a smart move after the turbulent year they've had.
Exactly. Investors love predictability, and that's what Evolent's aiming for.
All right, so we've covered a lot of ground here, but let's take a quick break and we'll be right back.
Sounds good. We're back. And we're still knee-deep in Evolent Health's Q4 2024 earnings call.
Yeah, it's been a fascinating discussion so far. Revenue growth, those profitability challenges, those crazy oncology costs, their plans for the future. It's a lot to unpack.
It is. But you know what? I think it's time we shift gears a bit. Let's talk about what it all means for you, our listeners. What are the key takeaways from Evolent's story?
That's a great question. I think one of the biggest takeaways is that Evolent is at a crossroads. They've definitely hit some bumps in the road, but they're also showing a remarkable ability to adapt and innovate in constantly changing healthcare landscape. That's crucial.
Absolutely. They're not just reacting to market forces, they're trying to shape the future of healthcare.
And that's something worth paying attention to. Whether you're an investor, a healthcare professional, or just someone trying to make sense of this crazy system, Evolent's journey offers some valuable insights.
It really does. It shows us that there are companies out there willing to take risks, to push boundaries, to challenge the status quo, all in pursuit of better, more affordable healthcare for everyone.
It's a message that resonates with all of us, I think.
It does, but it also highlights just how complex the healthcare industry really is. There are no easy answers, no quick fixes. It takes a combination of things: innovative technologies, smart strategies, and a deep commitment to patient-centered care. That's what it takes to really make a difference.
And that's where Evolent's focus on physician collaboration and data-driven decision-making really stands out. They're trying to bridge the gap between those who provide the care and those who pay for it, using technology to create a more efficient and effective system.
It's a bold vision, and only time will tell if they can fully realize it. But one thing's for sure, Evolent is a company to watch. Their story is a microcosm of the larger healthcare landscape, reflecting both the challenges and the opportunities that lie ahead.
It's true. So to all our Talk Tickers listeners out there, keep an eye on Evolent Health. Their journey is far from over, and I have a feeling it's going to be filled with twists and turns, maybe even a few surprises along the
There's
way.
definitely some surprises. And as always, remember to do your own research, talk to your financial advisor, and never invest more than you can afford to lose.
That's right. Because this is not financial advice, it's just our deep dive into the world of healthcare earnings calls.
And with that, we'll wrap up this episode of Talk Tickers. Thanks for joining us.
We'll catch you next time for another insightful analysis of the latest market movers. Until then, stay informed, stay curious, and keep those tickers talking. We're wrapping up our deep dive into Evolent Health's Q4 2024 earnings call. It's been a wild ride through their financials.
Yeah, hasn't it? Evolving is an appropriate word. When you think about their story, they really are at a turning point.
Absolutely. Trying to stay ahead of the curve in a healthcare world that just keeps changing.
Exactly. And I think there are some really great takeaways from Evolent's journey, insights that are valuable for investors and anyone who's interested in the future of healthcare.
Totally. I mean, for investors especially, it's a reminder that you have to dig deeper. Look beyond just those top-line numbers.
Yeah, you can't just see, oh, revenue is up or, oh, profits are down. You really have to understand the why behind those numbers. What's driving them? Are those drivers sustainable?
Like with those oncology costs we talked about. Huge challenge for Evolent, but also a chance for them to show what they can do, how they can innovate to find solutions.
Definitely. And their commitment to data and working hand in hand with physicians, that's key. It's really about using technology and human expertise together to try to get the best outcomes and control those costs.
It's a bold approach. It'll be interesting to see how it all plays out. But I think other companies could definitely learn from what they're trying to do.
Oh, for sure. I think Evolent's story is a perfect example of just how complex healthcare is. There's no magic bullet, no one-size-fits-all solution.
It's a constant evolution, and Evolent is definitely in the thick of it, trying to make things better, and that's something we can all appreciate.
Absolutely. As we wrap up this episode of Talk Tickers, remember, stay curious, stay informed,
and keep those tickers talking. This is not financial advice, just our perspective on Evolent Health's latest earnings report.
Always do your own research, talk to your financial advisor, and never invest more than you can afford to lose.
Thanks for joining us on Talk Tickers. We'll be back next time with another deep dive into the world of finance.